There's another look at U.S. futures. Not a whole lot of effect there in the futures market to those gross domestic product numbers we just told you about. They were released 3 minutes ago. Well, to help us break down the latest gross domestic product numbers south of the border, let's bring in Bipan Rai. He's Managing Director and Head of ETF and Alternatives Strategy at BMO Global Asset Management. Bipan, thanks a lot for joining us. I'll just remind everybody what the numbers came in at. This is a third reading on first quarter numbers, and first quarter GDP dropped by 0.5% from the fourth quarter. That was a steeper drop than it was expected. What was expected was a 20 basis point drop, and personal consumption rose, but it only rose by 50 basis points. The market was expecting a 1.2% increase in personal consumption in the first quarter. What is your take, Bipan? Are these numbers emblematic of a slowing U.S. economy?
Well, you hit the nail on the head, Paul. I think the last point is the most salient one, is that when we look at these revisions to first quarter data, really we're seeing a slide in personal consumption that we didn't see in that first reading. Now, traditionally, whenever we get revisions to that first number, insofar as GDP is concerned, you typically don't see this type of variation for something like personal consumption. So the fact that we have dropped from 1.8 for the advanced reading to 0.5 is something to take note of. And where that's coming from, I mean, certainly there's a slowing when it comes to household spending on durable and non-durable goods. But this last reading seems to indicate that spending on services also decelerated as well. So that's something that the Fed is going to take note of.
Colin Szynski has a question for you. He's our featured guest today.
Hi, good morning. We've seen with this is obviously the second revision now to Q1 GDP numbers, and my question is now we're almost at the end of the second quarter now, and what is your sense from the data over the last 3 months? Do we think this has continued, or this softness has continued, or are we seeing resilience in the economy now?
Well, it's a good question. And to be honest with you, until we get the data, we won't know definitively. Now, we could allude to the fact that if you look at real final sales, final sales to domestic purchasers, which tends to strip out net trade and also inventories as well, that's slowed markedly from quarters past as well. So you would expect some of that momentum to carry through. Now, offsetting that, we're moving at the speed of macro, and of the new news this quarter was obviously at the beginning when President Trump trimmed the extremes of his trade policy. Did that lead to a boost in consumption? Hard to say at this point, but again, we also have to marry that with our view of the employment picture. Certainly there's cracks starting to appear there, which also could curtail consumption at the margin. So again, we have different offsetting factors here that we'll need to take into account before we can make a proper assessment of whether or not this is something that is going to remain with us for a couple of quarters, or it might just be a one-off Q1 data point.
So am I hearing that you do not have a forecast for the U.S. gross domestic product growth for the remainder of this year?
No, we do, for sure. We do expect that growth is going to decelerate. I mean, that's just a natural happenstance of understanding that, insofar as trade barriers are concerned, they're certainly higher now than they have been in quarters past, which does tell us that at the margin, growth is going to slow. Now, the question for us is whether or not it's going to slow enough to tip the economy into potentially a negative quarter for growth. We don't see that at this point. At the margin, what we do see is the fact that growth is going to slow enough for inflation to decelerate and for the Fed to start its cutting cycle again towards the Q4.
As you know, Bipan, there are reports this morning from the Wall Street Journal that Donald Trump is getting ready to replace Jerome Powell much earlier than the normal schedule would provide for. Powell's term does not end until May of next year. The report is that Trump may replace Powell as early as September, or even perhaps earlier than that. Is that a wild card that you factor into your thinking at all, or can you not?
No, absolutely. You have to take that into consideration. Now, as far as we're aware, Trump directly firing Powell, I mean, that's not something that he's indicated publicly anyway, that he's willing to do before Chair Powell's term ends as of next May. I think what he might do, and something that will jolt the market, is announce a potential successor ahead of time. And that's something certainly that will matter for markets at large, given the importance of that position. But remember, if we're talking about the FOMC chair, really we're talking about traditionally what has been a consensus building role. It's not somebody that comes in and dictates dictates interest rate policy on their own. So that is, if Trump does announce somebody that's a little bit more orthodox, and in our view, it's still probably the most likely scenario. There might be a one-off reaction to President Trump's announcement, but over time, we'll gauge to see whether or not that announcement needs to be faded, depending on who fills the role.
Okay, so what the market sees right now from the Fed is 2 rate cuts by the end of this year, beginning in September. What is your call on what the Fed does in the second half of 2025?
So we're aligned with the market's call that we should see 2 rate cuts before the year is out. Where we tend to diverge a little bit is expectations for 2026. Now, right now, the market seems to expect that there could be 3 rate cuts. We see risks tilted towards there being potentially a little bit more. And again, that's predicated on the fact that we do see a slowing household consumption profile in the U.S. At the same time, we are expecting unemployment, I should say, to continue to rise. And at the same time, progress outside of any sort of pass through from tariffs, progress on the inflation front being made. So again, the Fed, in our view, is going to move from overly restrictive policy, moderately restrictive policy, let's say, to something akin to more neutral. And maybe there is room for the market to price in an additional rate cut in 2026. That should, at the margin, see 2-year yields move lower in the U.S. In the coming months.
Okay, I'll give the last question to Colin Szysinski.
One last question I had is inflation still a concern at this point in time when we're looking at the economy or at what might happen with tariffs or what might happen with monetary policy?
Are we talking about the U.S., Colin, or are we talking about Canada?
United States.
Yes. So in the United States, tariffs absolutely should be a concern in the near term. And again, in our view, we're very much of the same mind that a few of the Fed members are as well, is that it will lead to a one-off price increase. But again, the Fed is going to look through those one-off increases and really look at the guts of the fundamentals when it comes to the U.S. economy. And really, if we look at some of the core PCE measures, also other core inflation measures that we see released at different times, it really does suggest to us that the Fed will restart its easing cycle towards the end of this year. So to answer your question, absolutely, inflation is still very much top of mind. It's one of the reasons why the Fed hasn't cut so far, but we see that changing over the coming months.